Thank you very much, Michelle, and how nice to be here at the launch of this report, and thank you very much to Nest Insight for having us. My name's Oliver Morley. I'm from the Money and Pension Service, and it's a really important report, this. For the people that use us around the country for debt advice and money and financial advice more widely, a lot of them are only just getting by. Now, our most recent survey shows that around 26% of the population couldn't pay a £300 unexpected expense like a washing machine, or more widely. The implications are make or break for a lot of people, whether they then have to go to buy now, pay later, or to even a loan shark to get the money under those kind of circumstances. It is really important that they have a buffer. And we have been looking at this, obviously, for a long time. It was back in 2018 that Nest Insight came to us, and JP Chase, and also the BlackRock Foundation, to start testing the implications of sidecar savings, and most recently, obviously, to test auto-enrolment savings. Our role at MAPS is to help people in need find a way to a better financial future. And this work shows us three really important things about how we can better achieve that. The first is that savings matter when it comes to financial resilience. As I said, it is really important to people more widely. The second is that it is auto-enrolment that matters if you really want to make an impact. And the third thing is that the kind of research that Nest Insight has been driving really thrives on the partnership that we see today. Actually making this kind of thing happen makes a big difference. So I'm going to introduce Emma Stockdale, who is Nest Insight's Research Trials Manager, who's been leading on the real-world trials. These are really profound results, and I'm looking forward to hearing a lot more from Emma. Thank you.
Thanks, Oliver, and morning, everybody. At Nest Insight, we've been working on the question of how we support people to build financial resilience for the past 6 years. You don't need me to tell you that the savings gap in the UK is a profound and long-standing problem. Too many households haven't got any money in cash savings if they need it for an ordinary financial emergency that could happen at any time. A quarter of UK adults have less than £100 in saving, and many more would struggle to pay an unexpected bill of £300. And it's not just household finances that are hit. A quarter of employees say money worries affect their ability to do their job, and 1 in 10 have missed days at work due to financial concerns. The lack of financial resilience millions of UK households is hampering productivity and economic growth. Many employers are also realising that supporting their employees to build financial resilience makes business sense. Paying fair and livable wages is of course essential to financial resilience, but other supporting tools can also have a marked impact on well-being. Our sidecar savings trials with 5 large UK employers show that saving through payroll can be powerful. This trial was supported by BlackRock Foundation, JP Chase, and MAPS. In a payroll saving model, an employer puts in place a savings scheme for their employees with a third-party savings provider. If employees choose to save, money is moved automatically, meaning it's straightforward to save regularly. It's moved into savings before people get their take-home pay, which can make it easier for savers because they don't feel the psychological loss of putting money aside. It's also partitioned away from their main account, and while savings are always accessible when people need them, this partitioning can help employees stick to their savings goals. But although it's effective and supports the financial well-being for those people who start saving, there's one big problem. Sign up doesn't reach anything near the levels we'd expect. 46 out of every 100 eligible employees told us that they thought the product would be useful to them. Only 1 in 100 actually sign up. This problem is not unique to the sidecar trial. We've seen similarly low sign-up rates across other payroll saving schemes. There's lots of reasons that sign-up across the board for payroll savings is lower than expected. People lack confidence in themselves to sign up to be a saver. They lack the time or mental headspace to sign up, or they encounter friction in the sign-up journey. If we want to see actual take-up approach the levels of people who we think it would help, then we need to think about how we make it easier for people to translate intentions to save into action. This led us to explore whether an opt-out approach could help close the gap. In opt-out payroll saving, the default is flipped. If you want to start saving, you do nothing. It's the people who don't want to save who have to take action. This model preserves individual choice. There is no mandating of saving, but it makes it more straightforward for people who want to save to give it a go. All employees are given information about the savings scheme, with several reminders. If they choose to save, then it's all done automatically for them, and they start saving a default amount into a savings account each month or each pay period. They can change that amount at any time. They can withdraw their money easily at any time. They can stop saving at any time. There are no fees and there are no penalties. And if they don't want to save, they can take a simple one-step action to opt out before it happens. The evidence I share here is from real-world trials evaluated from several years of looking at over 1 million behavioural data points, showing us what people actually do, in combination with surveys and in-depth interviews that explore how people really feel about it. This is going to be a brief summary, but all the background information, the results, the case studies, the conclusions are available in our report, Easier to Save, which was published this morning. To explore opt-out payroll saving in the real world, we worked with 3 employers, Bupa, Co-op and Suez, and their workplace savings providers, the credit union Transave UK and employee financial benefits platform WageStream. I'd like to thank them, many of them are here today, for the time, effort and enthusiasm they've committed to this research. We are also grateful to the BlackRock Foundation and Money and Pension Service, whose ongoing support has made this work possible. There is a huge amount of data to explore, and we're grateful to our academic partners at Harvard and Yale who have worked alongside us and conducted a rigorous and robust analysis, which they have published in academic papers. There is a huge amount... Sorry, don't want to hear that bit again. Let's look first at one of the trials with Suez and the credit union Transave UK. Before the opt-out model was introduced, employees had access to payroll saving if they signed up. Only 1% of new employees to Suez actually signed up to save, very similar levels to what we see elsewhere. But when the opt-out approach was introduced, and new employees were signed up to save in the payroll scheme unless they said they didn't want it, that boosted participation to up to 48% of employees. That is a really meaningful boost in the proportion of employees saving. 47 percentage points from only 1 in 100 to nearly half of eligible employees. It's also very similar to the levels of people who told us that they thought they would benefit from this kind of tool. Those that didn't want to save in this way could really easily opt out, and they did. Employees saved persistently, with the majority of those saving after 4 months still doing so after 22 months. We saw a similar percentage point increase, about 53 percentage points, when we ran the trial with Co-op and Bupa, with the payroll saving offered through WageStream. Of new members to WageStream who had to sign up to save, around 15% sign up. When they were automatically enrolled, unless they opted out, this increased to around 68% of new members saving. These are phenomenal results. If you want to get appropriate proportions of people saving in line with intent and need, then nothing comes close to this opt-out approach. Previous interventions have tried incentives, using social norms, gain framing, in-person seminars, and nothing moves the dial quite like this, while still preserving the right of an employee to choose what to do with their money. Opt-out payroll saving is also effective in supporting people to build financial resilience. Employees typically save at the default rate of £40 per month. Where they do change it, on average, people increase that contribution. Within 4 months, those saving have about £100 saved on average. I mentioned at the beginning that 1 in 4 UK adults don't have £100 in accessible savings, but on average, employees that do save build this meaningful balance relatively quickly when it's made easy for them to get started. It supports different kinds of saving. People use their accounts for budgeting and cash flow management. They use it to build emergency buffers and to save towards goals. We sometimes hear employers wondering about whether their employees can afford to save. Yet we've heard from many employees who struggle to build a balance because money is too tight, that they still benefit from the opportunity to partition their money, use it and then replenish it again, even if they're doing that every month. In fact, the 10th and 25th percentiles of saving balances, that's the dark blue lines in these graphs, show a lot of people don't build a balance across the trial, but still choose to save each month. Workplace auto-saving is also additive to people's contribution in their workplace pension scheme. There's no negative impact on pension saving. People see these kinds of savings very differently, and so not only do they not choose one over the other, they also don't reduce their contributions in their pension in favour of saving for the short term. This approach is really popular. Around 9 in 10 employees were in favour or felt neutral about their employer offering an opt-out payroll savings scheme, whether or not they themselves chose to save. We've heard from many employees that they are grateful to their employer for supporting them to get started with saving. Importantly, the opt-out approach gets the people who want to and need to save, starting with saving. We see that across a number of demographic, socioeconomic and attitudinal factors, the opt-out approach is as or more inclusive of the people who need savings most. It reaches the people who lacked savings before and who rated themselves as low in financial confidence prior to the trials. I've been privileged enough to speak to some of the people who experienced opt-out payroll saving and have been blown away by how a simple change in the default can have such a profound impact on people's lives. They talk about control, empowerment and dignity, and we'll hear from some of them later this morning in our Save a Film. I'm delighted now to pass over to my colleague Jo and our panel of speakers to think about how we might scale the approach piloted in these trials to reach more UK workers so that more households can build the peace of mind that having a financial buffer gives. Thank you.
On the money that's diverted, because that's really an important part of the savings part. We need to be clear about the complexities around diverting an element of the contributions away from the pension. I mean, the monitoring of employers' payroll file of pension contributions, making sure you're getting the right contributions in, is a big part, a big activity, perhaps, particularly if you're a mass employer, of the compliance regime. And if some is diverting off, how do you know it's going to where it should do? How do you know it's ceasing to be diverted if someone's opted out? And we don't want to create another example of millions of savings pots that are not transferable when people change jobs and people have to have more savings accounts other than every time they change jobs. So those are not overcomable, but I think there's some of the challenges that have to be dealt with in what's already a a demanding pensions reform agenda if this is going to succeed. I had several more, but I'm conscious of the time being handed up, so I'll stop.
That's brilliant, thank you, Jeannie. And one of, I think, my ambitions for today was to share the results from the trials, but also to start to get into the what next and to start to think that through. And I think you've given us there a really good set of things to work on in the coming weeks, so thank you. Femi, as a sort of representative of one of the pension providers of that part of the system, what role do you see pension providers potentially playing in building a system that is both more financially inclusive and also that supports shorter term financial security as well as longer term retirement financial security?
Thanks, Jo, for having me. Good morning, everyone. So, when you're going last, actually, you probably have to work out what to say, because most of the panelists probably said what I wanted to say. So I thought I would start probably with a bit of a personal story. So I'm the son of a Windrush migrant. My dad was denied access to banking, credit, even work. So this probably is quite deeply personal to me. But one thing he instilled in me, you probably saw I brought this pyramid on the stage. He instilled in me Maslow's hierarchy of psychological needs. That you want to get your foundations right, so the psychological foundations at the bottom before moving towards your aspirational levels. And I apply it in my work today. I know it's not a linear subject, but actually if we look at what most of our employees today, the workforce, or whatever we want to call it, human capital, is going through, most are struggling to build that base of financial resilience that they need, the good behaviours that they need to channel in order to deliver better resilience. And then when you move up a step on the pyramid, it's about actually, day-to-day finances, managing your day-to-day finances, building that savings buffer, as we're talking about here today. And then as we go further up the triangle, it's your ISAs and your pensions, and then your long-term legacy at the top. But the reason why that's a really important concept is because what we've seen and heard from the panelists today is auto-enrollment has done, the top half of that triangle. It's provided access to 10 million more individuals and counting in order to save for a pension. But actually, the reality is there's a huge population at the bottom of the pyramid that are still struggling with their financial resilience. So where do we really want to go from here? I think it's fair to say that pensions, it has historically been treated in isolation to wider finances, almost disconnected, if you want to use a better word for one. But I think really that stems from the regulator's role in trying to ensure that savers are protected. If we flash back to the Maxwell scandal in the 1990s, it was from there which we then introduced the Pension Act, which helped protect savers and protect assets. But I think what probably ended up happening is pensions probably felt a bit more remote, and actually they need to be part of the everyday life. But we've seen through auto-enrollment, pension freedoms, that fundamentally the landscape's changed today, right? People recognise that retirement isn't just phased, and actually, or retirement is phased, not just once in a lifetime opportunity. But I want to talk about what our research at Standard Life shows us today. So we did I'll just put it up actually, because I've got it with me, and it's nicer just to show things than always be talking. So we did a survey of our members, and I know it's quite small, but I think just pay attention to the blue squiggly line if you can. So we did a little survey just asking people what their top financial priorities are. And actually, that blue squiggly line represents people's changing contributions. And as you can see, that's quite low down the financial priority list. And what we saw most people was doing was what was at the bottom of that pyramid, of the concept that I spoke about. They're really trying to just build their day-to-day financial knowledge, build a rainy day fund, save for property, and so on. And actually what we've found in our most recent survey, our Retirement Voice survey, is actually savers are also just getting to grips with everyday money changes that are occurring, such as the rising energy crisis. But I think the key thing here is that we, as a pension fund, know we need to empower people and in particular lower earners, in building rainy day funds, and also ensuring that they can establish or at least have financial security in the short term as well as in the long term. But we absolutely recognise that we have to protect what we've achieved through auto-enrolment today, which is why I agree with everything that Baroness Jeannie said. But the challenge is, how do we make pensions relevant for the average working individual today? And so, again, from a Standard Life perspective, we are very keen on exploring sidecar savings and what that could mean for everyday savers. But at the same time, we also recognise that there's probably a need for a holistic financial wellness strategy across government, employers, providers as well, because we are really reluctant to see any, I guess, trade-offs when it comes to people make with their pension and their finances. I just want to leave you with one last thing, which is, ultimately, this does rely on employers, and hopefully I can talk about this later on. They are strong advocates for their employees and what their employees want to achieve. And as we've been able to see from the employers in the trial, it significantly helped in terms of pushing everyone in the right direction. That's just a...
That's brilliant. Thank you, Fenley. And thank you all for your remarks and your consideration of the question, how do we boost savings inclusion beyond the pilots? We are going to run out of time for sort of more discussion into all of the elements of those. So I'm going to be a bit mean, possibly, and ask each of you just to sum up both a sort of thing, a design consideration you think we need to think about as we go forward. So what's one thing for you that feels really important as we evolve this and we think about scale? And then also just thought on what could success look like. So we've talked about some of the challenges that we need to work through, but just any thoughts on where we're trying to get to and what that could mean. So a design consideration and a thought on what success looked like. Does anyone particularly want to go first? Jeannie?
Okay. Well, it has to be targeted. I don't actually agree with it being universally available across the piece. I think it poses too big a challenge to the amount of money that would be taken out of pension savings at the aggregate level. And I think you have to be careful about how much people can draw down and how you refill it, because if you keep drawing down 1,000 and keep refilling it, cumulative, you could start drawing down an awful lot of pension saving. And I worry that we don't create something that actually widens the gender pension gap, because it's women and particularly single mothers who are particularly vulnerable. So I would want to look at how you target it and what are the parameters about what is diverted into. Secondly, I would want it done in such a way that doesn't pose any threat to the absolute success in which we're doing auto-enrolment at the moment, which is basically minimal engagement. And lots of people don't even know the lesson telling them they're in a pension scheme and introducing something that might alert or raise that level of engagement. So I think that's really important. And secondly, if you're going to start diverting savings across millions of employers, you have to have a compliance and checking regime around that money, particularly to extend it to SMEs, where 60% of private sector workers work, because that whole compliance about knowing what money should be coming in, that it's coming in, and if it's diverted where it's going, I think is really, that's a challenge for the DWP, I know, and I would be working with providers on that very, very closely to get their views around the whole administration of such a thing. They'll know the challenges. If there's any sitting here, they probably know what I'm talking about. That's just a few.
Thank you, Jeannie. Lots for us to think about. Sally?
Yeah, I'm just going next. Yeah, no, absolutely. In terms of the design consideration, yeah, I think I would probably like us to think about it in terms of the consumer needs. So we often in financial services think about products, and we like to categorise. But I touched on our new strategy, and we are very much trying to think about how, as a regulator, we support consumers through their financial life journey. And so I'd like to see savings being thought about in that context, and it's probably consistent with that message from Jeannie around, like, let's not kind of get benefits over here while creating problems over there. So thinking about it in terms of that sort of integrated approach would be really important, I think. And then in terms of what does success look like, I mean, it's quite unusual to have such a kind of strong and compelling evidence base, so I think it'd be great to be able to move now from talking about things and kind of concern about barriers, many of which I think are valid concerns, into, well, let's talk about the practicalities and let's put that energy into working through how can we work together with the right people to overcome those where we need to. So that's probably what I think success looks like.
That's great, thank you, Sarah. Mike?
Yes, I was thinking about success differently. I was thinking, we measure all the time how many people don't have savings, wouldn't cope with shocks, can't pay unexpected bills. So that's your metric for tracking the success of this program overall, isn't it? Right. In terms of design considerations, I think I'm just going to repeat what Baroness Strickland. I was very struck by her warning against any policy creating lots of orphaned pots. So sorting out what you do when people change jobs seems really important, and I do share her concerns as I raise in my remarks as well about the trade-off between this and pension saving. So it's fantastic that your trial showed there didn't seem to be any negative impact on pension saving. So it'd be good to understand whether you think that was something about the way the trial was implemented that meant there wasn't that trade-off, or maybe it was the kind of employees you were targeting. But that does seem absolutely fundamental, that we don't want to reduce pension savings from where we are. The policy we recommended was about increasing contribution rates and then diverting, not diverting from where we are.
Yeah, which is effectively what we've done in the pilots. We left minimum pension contributions as they were, and then we added the cash savings on top, and I think that meant that the overall savings rate across the two was higher. Ben?
Thank you. So I think from my perspective, this is sidecar savings has the ability to again drive that financial inclusion, but I think what we need to make sure is that the outcome of that is a financially healthy system, and so in terms of design considerations, I think are quite key. It again comes back to what the panel have said about parameters. We think that actually you'll probably want to take some sort of holistic approach to the pension review that could happen this year, and perhaps, for example, it's things like having minimum contribution levels that have to be paid by the employer, because we want to be able to get over the fact that some individuals might actually opt out of their pension or reduce their pension contributions. So I think we need to be able to put in the correct parameters that could offset some of the potential issues. What does success look like? I think for most pension providers, it comes back to economies of scale. If this can be mandated across the industry, then I think we will have successful adoption across the industry.
Brilliant. Well, thank you all so much, and thank you for helping me to manage, I think, perfectly to time. I'm grateful to all of our panellists for helping us start to think through some of the opportunities and challenges as we look to scale these approaches, and hoping that all of you in this room are now signed up to help us work through those considerations that have been highlighted today over the coming weeks. Many of you in this room have already contributed your ideas and your expertise, and we look forward to working with all of you going forward to try and flesh out and address some of the questions that have been raised today. So I'd like to thank all of our panellists, and then I'm just going to show a quick film before we welcome the Minister to the stage. Thank you all very much.
It feels really great knowing that I can solve problems with my accessible savings, without having to borrow. It feels really great. It's one of the best feelings.
It's important for having security and a backup, and it's that comfort of knowing it's there, really.
So you always need savings, because you are always going to be faced with your car breaking down, you need new tyres, or your roof leaking. You just need savings as a backup that are accessible.
Once you get paid, obviously some will go into savings, which then makes it easier to save.
You don't notice it coming out because you never had it in your wages.
To have savings is a confidence booster. it makes you calm. You know that there's something laid up somewhere.
It feels quite reassuring to have an amount you can always fall back on.
One of the things I found with saving being quite difficult to do and never quite being able to get there, this is the sort of first time I've had an opportunity to save, which gives you quite a nice feeling of self-worth, because you feel like you're achieving something for once without it all disappearing out of sight.
I feel it will really help. Just by that little amount each month will really help that January, and January blues might not be there.
I know the money's there if I need it for a rainy day, or if the washing machine breaks down again, it's always there to help.
In a way, it gives me security at work because I feel I have options and choices.
It's important that an employer creates an avenue for people to be able to not run into borrowing or credit cards and everything.
You feel looked after, and I think that makes you want to work better for them.
I reckon every employer should offer this to their employees, because I think it's a really good scheme, and at the end of the day it helps everyone out.
Yeah, it just seems a bit of a no-brainer, really.
It's your money, it's solving problems for you.
So we are absolutely delighted to have Emma Reynolds join us today. Many of you will know Emma, who was for a while the Pensions Minister, which is relevant to a number of us in this room, but has more recently taken on the role of City Minister and Economic Secretary to the Treasury, which means, among other things, that her remit includes the financial inclusion strategy, which has been mentioned a couple of times today, and to which our work, we hope, is super relevant. And I would say, just a brief observation to start, with Nest Insight, a lot of what we're trying to do is help with an evidence base, right, that other people can use. And part of that's about employers and financial services providers, and part of it is about government. We're trying to kind of help by producing evidence for what can help people and what can work, and that's what we've tried to share today. So it's great, Emma, to have you join us. Thank you.
No problem.
Thank you for doing so.
Good afternoon, everybody.
And for making some time. I wonder if we could just start with the financial inclusion strategy. So you've obviously taken over responsibility for visit. It had sort of just got started, I think, when you moved across. So just any reflections on how that's going, on where you expect it to go, what's covered, how's it going so far?
Yeah, thank you. So good afternoon, everybody. Good to be with you. So I'm really excited about the financial inclusion strategy. We are a Labour government and we care about inclusive growth. Our number one mission is economic growth, but that's in order to make people better off, and not just one group of people. We want to spread that opportunity and wealth across the country, and financial inclusion is part of that. We know that there are shockingly over 1 million people who are unbanked. We know that 11.5 million people have less than £100 in savings, and it's difficult really to understand how that would make someone feel, and I think that's why the video was so good. That feeling of insecurity and the consequences of that, and if you then get into trouble in some way or need some sort of savings and you don't have it, then getting into debt is really... So one of the work streams we're looking at actually is access to credit, but really if we could take forward some of the reforms that you're suggesting, hopefully, we wouldn't need people to have as much access to credit anyway. So I'm excited about how all the different work streams fit together. I chaired the second meeting of the committee. I wasn't in place for the first meeting, so I'm sort of taking over the baton from my predecessor. But we're looking at 6 different areas, and there's a few people in the room who are involved in some of the subcommittees and leading the subcommittees. So we've got digital inclusion and access to banking, access to credit, access to insurance, problem debt, savings and financial education. And actually what you've been working on is pertinent to many of those, not just to the savings issue. It's to avoid the problem debt, it's to ensure that we have better financial inclusion. So yeah, I'm really excited about the strategy. We want it to be industry and third sector led. We want it to be a collaboration between the 3 main players, so ourselves, the financial services industry, and also consumer representatives. So I think it's going to be a very exciting time to be involved in this policy formation, and we promise to deliver the strategy. We'll deliver it. We will come up with a strategy by the end of the year, and then the proof will be in the pudding as to how we take it forward.
Fantastic, thank you. And you talked there about how all these different things interact, and we talk a lot about a step change statistic. Having £1,000 in savings helps to half the reduce of problem debt, sorry, half the risk of problem debt. But just honing in on savings for a minute. So traditionally, I actually used to work on financial inclusion policy in DWP 20 years ago, and it used to just be about access to products. As long as you could sort of say people can get a savings account, or a bank account, you kind of felt like that was the end of it. But we know through our work that actually the barriers to saving is a bit more complicated than that. Often people have access to products, but there are other things getting in their way. So I just wonder, when you reflect on the savings bit of the financial inclusion strategy, what's a good outcome look like for you here? Where would you like the UK to be in a few years' time on emergency savings?
Well, firstly, let me say I think it's important that we pay people properly in the first place. So from tomorrow, 3 million of the lowest paid workers in the country will be £1,400 on average better off, thanks to our government increasing the national living wage. It's difficult to put a number on it. I know you've put a number on it. I suppose the way I think about it is, are people able to save to give them the security we just heard about, what that gives them in terms of peace of mind, but for an emergency? So one of the chaps on the video talked about if your washing machine breaks down, or if you've got less than £100 in savings and it's quite a big breakdown, then that's going to be an issue. Or if your boiler breaks down in the middle of winter, which they often do, don't they? I don't know what it is. You never have problems with boilers other times of the year, but except when it's really cold. So an emergency saving to ensure that the lowest paid workers had an emergency saving in case of emergency. If they rely on their car for work and their car breaks down and they can't afford to fix it, they might lose their job. So we want to avoid people being in that situation. We want to ensure that they are financially resilient enough to withstand those shocks. Obviously, ratcheting that up to the rainy day savings, if you lose your job, could you have a 3 to 6 month buffer? That is much more difficult. But certainly, ensuring that people have those rainy day savings in order to withstand a smaller shock, it is something I think we should be aiming towards. And at the moment we don't have that.
Yeah, no, that's great. It's great to hear you talk about sort of pay. I mean, it's something that came up in the earlier panel as well. You can't fix financial resilience without first fixing pay and workers' rights agendas, which are obviously very forefront for the current government. So it's great to make that link. Now, obviously, you said, and lots of people said, so the organising objective of this government is economic growth. Everyone understands that it's kind of central to living standards and financial resilience. Intuitively, it sort of feels like, and you mentioned a good example, if your car breaks down and you can't go to work, you lose your job. If you're worrying about money at work, there could be a kind of productivity impact. There was some research, I think, published in the US that showed that actually workplace accidents reduce if you reduce people's worries about money. But I just wonder, from your perspective, do you see a strong link between kind of household financial resilience and the economic growth agenda? Is that something you can talk a bit more about?
Absolutely. I mean, you just laid it out pretty well. I mean, maybe it's not that obvious, but obviously we don't want people to get into problem debt and then have to resort to borrowing money in a way that's not affordable, which then puts them further into the red, and then they are less able to deal with any additional shocks that they might get financially. And then we certainly don't want them to become economically inactive because, as you say, their car's broken down, they literally can't get to work. So I think not having a financial inclusion strategy, not helping people get savings would be bad for economic growth, and the opposite is true. But let's be clear, we talk about economic growth, and I think, we think about lines, certainly in the Treasury, we look at lines on a graph, but what we're talking about is actually delivering higher standards of living for people across the country. That's what we're talking about. That's the aim here. We might talk about economic growth as a shorthand of that, and that is the number one mission of this government, as you've heard many times already from me today. But it's a means to an end of making people better off. That's what we're about.
Yeah, no, that's fantastic. So the report that we published today is the sort of latest opportunity we've had to talk about specifically opt-out savings models. So we know, and we talked about it on the panel earlier, pensions auto-enrolment has been an absolute game changer in participation in retirement saving and longer term saving. And the work that we've done really shows that if you use the workplace as a vehicle to offer people access to an emergency savings tool, people like the idea, but they don't actually much get around to using it unless you also do that on a kind of auto-enrolled or opt-out basis. And the findings of the research are very clear that makes an enormous difference. But this is a sort of newer idea in the world of cash savings. We're quite used to it in pensions auto-enrollment. So I just wondered if you could share any kind of reflections on the model and any thoughts about the opportunity or the risks that might go with it.
Well, it's relatively new in pensions, thanks to Jeannie Drake here and others on the Turner Commission. We know that inertia works, doesn't it? We know it works because prior to automatic enrolment in pensions, we had so many people who didn't have any pension savings at all. And we know from the rollout of auto-enrolment pensions that actually very few people opt out. Once they're in and they're informed of it, they don't opt out. Inertia works. So it's interesting to see from your trialling of, by the way, I think we do need a better name for it. I don't know whether it's work to save or I don't know what it is, but we need a catchier sort of. Can't be opt-out savings. It just doesn't sound that exciting, does it? But the people on the video were well into it. They're the people to sell this, really. And it was really powerful, I think, to hear their reflections, especially the chap who said, oh, well, I really knew I should be saving a little bit, but I never got around to it. And this enabled me to get around to it because it's inertia, isn't it? It's coming off your pay. Well, it's coming into your savings account automatically rather than you having to make an active decision not to spend that amount of money by the end of the month. So I think auto-enrolment in pensions has demonstrated that inertia is necessary in many people's lives in order to get them to save for their pension, and it certainly seems that it's a precondition in getting them to save a little bit of money as well. And we are talking about people on low salaries. It's easy for many of us to put a little bit away, or it might not be, I don't know. Depends on your expenditure, I guess. But I think that there's many lessons that we can learn from Jeannie's work that relate to pensions that the read across is there with savings as well. Sure. But it was interesting to see in your study that, and thank you, by the way, I should say, to MAPS, we've got Oliver here, and BlackRock for your support, for their support in funding the research. But it was good to see that it didn't crowd out the pensions auto-enrolment that these people already enrolled to save towards.
Yeah, no, that's...
Because that might be a worry, mightn't it? That you might present people with a way of saving that allow them to have that saving and that access to the saving, and then they might opt out of their pension contributions. That's what we don't want to see. And I know that there's been some research around sort of sidecar savings for the self-employed. We have a huge problem with the numbers of people who are self-employed not saving for any kind of pension. So I know that's a slightly different issue, but I don't know if there's any of the lessons from your research that we could apply to that problem as well.
So it's a really interesting point. It's actually something kind of elsewhere in our work, looking at long-term saving among the self-employed. That's a question we're asking ourselves as well, because there does seem to be this sort of natural fit for the self-employed with a bit of cash liquidity, given the kind of volatility of their income.
And whether you could design a product that the cash liquidity tipped at a certain point into pension savings if in the first place these people weren't saving towards a pension, but then they could keep some of it back for that emergency savings provision that they need.
Well, watch this space.
Okay,
we'll
excellent.
We'll bring you back for a conversation about the self-employed in the future. And yeah, I mean, it's great that you've picked up on the pensions savings crowding out point. I have to say, when we first started this work back in 2018, the question we were asked the most by Treasury officials kind of throughout has been, what about the crowd out of pension savings? What about the crowd out of pension savings? It's been great to actually have some data to support that.
Indeed.
I mean, you talked about one there with the self-employed. I just wonder if you've got any other reflections. I mean, where else do you think there are opportunities for innovation here in the savings space? What else, the government's talked about kind of expanding the mutual sector. Where else do you think there is an opportunity here to help people to build cash savings?
Well, being a bit of a pensions geek, I am excited about the pensions dashboard, and I am excited for us to have it sooner rather than later. Looking at Oliver. no pressure. I think that will be a game changer, and I think already financial services firms have already massively upped their game to 10, 20 years ago. When Jeannie was doing the Turner Commission, we didn't have that sort of access to look at our savings as easily as we do now. It's more difficult in pensions because of all the different places you might have worked and how you bring those together. And I don't envy you the project, by the way, but it would be wonderful to see that come together. So I think there's clearly a bigger role that technology can play in all of these things, and empowering people. That's what we want to do, isn't it? These people on the video were empowered by the fact that they had some savings and how that made them feel, that peace of mind, that ability to plan for the short to medium term. So I think there's lots of clever ways that technology can be used, but I'm looking to you and others to bring forward those ideas. I'm just a minister.
Absolutely. I want to just for a minute, just whether you'd be able to reflect on, because I mean there are kind of other things government has done, right? Help to Save being one of them.
And extending the eligibility from next month. It's April tomorrow, isn't it? Yeah. So all universal credit claimants will have access to that scheme.
And just thinking about take up of Help to Save, is there more on the agenda? Do you think there might be opportunities around kind of some of the opt-out mechanisms we've tested that could help with take up of Help to Save?
Yeah, it's not something I've been able to give a lot of thought to, but I was actually asked by John Glenn about this in the House recently. So I do think we need to think about how we promote it better, because it is a great scheme. But I'm not sure that the awareness is really there. Yeah. So yeah, it's something that I'd like to look at in more detail.
Absolutely, one for another time, one for the future. So you and I talked briefly outside, and this was discussed a bit on the panel as well. So as we've talked to employers about opt-out savings, you know, this message does come back to us that a lot of employers have perceptions about kind of regulatory barriers, things that make it difficult for them to do this for their employees if they kind of want to. And kind of to date, really, it's only the trial employers who we've worked with in kind of great detail to figure out how to do this who've been able to really run the opt-out mechanism. And some of this is about financial regulation, and some of it's about data protection, and some of it's about kind of minimum wage. And of course, only some of those things fall under your remit. But I just wonder if you had any reflections on kind of, you know, what the opportunity is there with regulation to see if we can do a bit more to kind of unglue voluntary take-up for employers of this kind of model. Yeah,
well, it sounds like we need to do a lot more to ensure that employers have got the confidence that there's regulatory clarity on this. GDPR, other issues. I know the FCA is already looking at making sure that we do have that clarity for employers. I'd like to see that happen. I mean, it seemed a bit of somebody on the screen said it's a bit of a no-brainer, and I think that if you had a couple of particularly big employers doing this, if you think, I don't know, like a Tesco, they've got some really good pensions people at Tesco, then you might then create a bit of FOMO around this, and people get to know it a bit more. Oh, there's a couple of the big employers in the country doing this, and then you might even get some of their employees asking them, oh, my friend who works at X company, they have this thing, we'll come up with a better name, auto-enrollment for savings, I don't know what we call it. Then you might find that, the popularity of it starts to increase. But we certainly need to ensure, from a governmental and a regulatory perspective, we provide employers with that clarity.
Great, thank you. Just probably a couple more questions before we think about wrapping up. So obviously, prior to this role, you were the pensions minister briefly.
Yes. I've been longer the pensions minister than my current job, but it doesn't feel like it somehow.
These things pass very quickly. I mean, I was at an event on Friday, and your successor in the pensions brief was being given a hard time about how often the person in that brief changes. So it's a
wasn't necessarily his fault.
No, quite. Absolutely, but. So we've talked about in the roadmap we put in the report, and others, Resolution Foundation and the IFS have sort of started to talk about, as we think about the future evolution of pensions auto-enrolment. I think at the PLSA last year, you were highlighting that when we think about pensions adequacy, clearly on the one hand, it's clear that some more people need to save for their retirement, but on the other hand, there is a trade-off there with people's financial resilience in the short term. And so we and others have started to talk about, is there an opportunity here to think about putting some form of emergency savings component into the auto-enrolment framework as part of its future growth and expansion. Now, I'm not going to ask you to commit to anything. You're no longer in the pensions group. Just interested in your reflections on that. Is that something you think is worth looking at? Would there be things about it that would worry you that we should be thinking about in terms of kind of design considerations?
Okay, so my overall worry is that we had this tremendous sort of quiet revolution of auto-enrolment, but actually I think people perhaps have got, I don't know if Jeannie would agree, a full sense of security about it. It's been done for them. They've not opted out because they see the value of it, and therefore they're going to get this great income in retirement because they don't really have the visibility that the dashboard would bring to see, how much they will be being paid in retirement. And frankly, many of us don't, do we? I mean, I don't know about you, but I've got several different pensions. I've got DC pension, DB pensions, in and out of DB. I lost my seat in 2019, so anyway, then I was in a DC pension, now I'm back in a DB pension. I mean, just having that visibility of how much you're actually going to need in the future is quite tricky, and that's for people like me who think about it, right? So how can we help people plan? Certainly pension dashboard's going to really help with that. What's the interaction between helping people put some more money into some savings account for a rainy day and their pension? I'm not committing to any new government policy in the pension sphere here, because Torsten would be very cross. You might have been cross with him that he was the new minister, but he might be very cross with me in taking decisions on his behalf.
Right.
But I think we need to think about it not from the point of view of policy or which department or which minister, but from the point of the individual. What I'd be interested, the people that you interviewed for the video, what would they think about all of this? How would this help them? How could we have a system that's more joined up, where we recognise that people need to contribute to pensions, but they also need some rainy day savings for an emergency, or possibly even a little bit more in case they lose their job. So I think we need to think in the round about it, but I don't have any new government announcements for you today.
Entirely reasonable, and great, I think, to bring it back to the end saver, which is a big part of our focus as well, and I think that's absolutely right. So look, we're almost out of time. We're extremely grateful to you for sharing so much of your time. I'll just, sort of final question, you've come into this role, you're on top of the financial inclusion agenda. Is there anything else you would like to see in the next phase, either from the industry or from research organisations like ours, that would help? What else is needed here to kind of help fill out this picture in terms of how we really do address these problems, particularly for low and moderate income households?
So I think there's lots of questions that I still have, because I'm still relatively new in this brief. Started on the 14th of January. Seems like a long time ago, but isn't. So, this sort of strays a little bit beyond what we're talking about, but why are there so many people who are unbanked? I went to this fantastic breakfast that MasterCard and Barclays organised, and one of the people there was saying that actually a lot of these unbanked people were banked before, and then something's happened, or they've chosen not to be banked. I just find it extraordinary that you could be getting along and living life without having a bank account. I find that extraordinary. 1.1 million people without a bank account. What can we do about that? Jazz Singh from Lloyd's Banking Group is chairing a subcommittee to look into that. Hannah here is chairing the Access to Insurance subcommittee. I suppose what we need to do with the financial inclusion work is make sure that we are thinking about this all in the round, because most of the issues that we're looking at, it's often the same people who are experiencing these problems. So it may be that you're unbanked, you can't get access to any sort of credit, and by the way, you can't get any car insurance or contents insurance for your flat, and then something happens. So I don't think we've got the answers yet, and I think we've got to work out what's the balance, who does what, really. We've got to prioritise, so Hannah knows this, because we can't boil the ocean here. We've got to look at what are the meaningful things that we can do to deliver outcomes, to ensure that people are financially included, digitally included as well, and more financially resilient. And that's going to require all the 6 different work streams that we talked about to come together and not be done in silos, but there will be specific things in those work streams that we need to look at too. Sorry, that's a bit of a roundabout way of saying we've still got quite a bit of work to do. We're at the stage now where we've got the problem statements. I think we probably still need to do a bit of prioritisation within those. And then we're starting now at the difficult stage, which is what are the solutions? What are the solutions that we can deliver together to solve some of these problems.
No, that's a great place to end, I think. So in just a moment, I will ask everyone to join me in thanking the Minister for being so generous with her time. And then I'm going to hand over to Gavin Lewis, who is, many of you will know, is the Managing Director at BlackRock, and as has been mentioned a couple of times already today, the BlackRock Foundation has been one of the major supporters of this work over the years, going right back to 2019. And Gavin has personally been a great personal supporter of this work, for which we're very grateful, and he's going to say a few closing remarks. But before we do that, can everyone please join me in thanking the Minister?
Well, thank you for the just the personal note. So I think I wrapped this event, I think it was in 2019, and I've had the privilege of bearing witness to the important work that Nest Insight has done, which personally means a lot to me. So just a personal note to say thank you, and allow me to wrap again. Good afternoon, and thank you, Will, and obviously thank you, Minister, for your remarks, which clearly demonstrate your continued dedication to advancing economic security of people across the UK. We do think that your commitment is crucial. We know how important this is, and it's great to obviously see you here, and also welcome your words of support for Nest Insight and the emergency savings work that we all know is an imperative. So as Will mentioned, I head BlackRock's institutional client business in the UK and Ireland. And in this capacity, as I've said, I've had the honour of working alongside the talented team at Nest to provide its members with the investment and savings tools necessary to build their long-term financial well-being. BlackRock and Nest's missions are closely aligned, anchored in a shared commitment to improving financial well-being across the UK. And since its inception, Nest has continually shown leadership and ingenuity in supporting UK financial security. And there's no greater example of that than in establishing Nest Insight as a public benefit research and innovation centre. Nest Insight has significantly contributed to our understanding of the most impactful financial wellbeing interventions. And to advance these, BlackRock has supported Nest Insight's workplace savings programme alongside the Money and Pension Service since 2019. And as part of our emergency savings initiative, I've personally had the privilege of being involved in many of the BlackRock Foundation's key programmes in the UK, including working with our social impact team, who are here, and the Nest Insight team on emergency savings, which to date has led to 8 trials, obviously some of which have been mentioned already. So 8 trials with leading employers, including 3 opt-out trials, again discussed today. And in total, over 150,000 workers across the country have had access to these provisions in the course of the trials. Today's event has been a great reminder of how far we've come since the start of our partnership on emergency savings. But also a reminder, as Baroness Drake has rightly said, that there's still much work to do. As we've heard, there's ample evidence showing the power of auto-enrolment workplace savings solutions. Let's not call it that, because that is a real mouthful, in driving tangible and positive change. But it's still too difficult for employers, even larger ones, as again was exemplified by the research shown, to provide those benefits to their employees. More work is needed from all of us to make sure the most impactful solutions are available to everyone. From our perspective, we are committed to continuing this work. I'm pleased to announce that the BlackRock Foundation will provide Nest Insight with £1.5 million over the next 3 years to expand the availability of this impactful workplace savings solutions to all workers in the UK. I look forward to working with Nest Insight and all of you to continue democratising access to these life-changing solutions. Now, coming to my role today, I have the pleasure of closing proceedings and saying a huge thank you to everyone who has made this event possible. Firstly, thank you to everyone at Nest Insight, Will and team. Again, it's been a testament to you and the work that you are doing to improve financial resilience of the UK's working population. To the panellists and moderators, thank you all for your insightful contributions in such an important field. I also want to thank the pioneering employers and delivery partners who have made these research trials possible. We know this is not easy, and you should all be incredibly proud of the work that you are doing and the impact it's having on your employees, clients and the community at large. And finally, thank you all for being here today and your commitment to this crucial mission. Thank you.